Something shifted in the financial markets over the past 3 weeks. And if you've been watching silver, you already know what I'm talking about. The metal that most investors ignore just moved in a way it hasn't in years. Not a slow drift, not a minor adjustment. A violent, multi-directional swing that caught headlines, confused traders, and sent a signal that very few people are prepared to interpret correctly. This isn't about price targets. This isn't about getting rich quick. This is about understanding what's happening beneath the surface of our financial system, and why silver's recent behavior is telling us something important about the economic environment we're entering. If you hold silver, you're probably asking whether this changes anything. If you don't, you're wondering whether you missed something or whether this is just noise. Today, we're going to answer both questions. I'm speaking to you as someone who has studied markets through multiple cycles, who has seen euphoria turn to panic and back again, and who has learned that the most important insights come not from predicting the future, but from understanding the present with uncommon clarity. What you're about to hear won't sound like most financial commentary. There will be no hype, no promises, no emotional manipulation, just a clear-eyed look at what's actually happening, why it matters, and what thoughtful people should consider as they navigate what's ahead. Let's begin with what changed. 21 days ago, silver was trading in a range that had become almost boring to most market participants. The metal had established a pattern, predictable, stable enough to be ignored by mainstream financial media. Then something broke. Within days, silver moved with a velocity and volume that hadn't been seen in that time frame for years. Not just up, not just down, both, violently. In a compressed period that suggested something fundamental had shifted in how the market was pricing this asset. The swing caught algorithmic traders off guard. It caught retail investors off guard. And more importantly, it revealed something about liquidity, positioning, and the underlying tension in monetary metals that had been building quietly for months. Now, before we go further, let me be clear about something. A sharp move in any asset can mean many things. It can be technical, it can be temporary, it can be noise. But when silver moves this way, especially in the context of what's happening across credit markets, currency markets, and sovereign debt markets, it deserves a closer look. Because silver doesn't move in isolation. It moves in relationship to confidence, to inflation expectations, to real interest rates, to the perceived stability of the financial system itself. And right now, all of those factors are in flux in ways most people aren't fully grasping. The immediate narrative you'll hear from conventional sources is simple. Traders repositioned. Momentum shifted. Technical levels broke. And yes, all of that is true at the surface, but it misses the deeper question. Why now? Why this magnitude? And why, when you zoom out and look at the broader macroeconomic picture, does this move feel less like a random fluctuation and more like the early tremor before something larger? Here's what happens when silver makes a dramatic move. People immediately divide into two camps. The believers rush to declare victory, to proclaim that this is it, the moment they've been waiting for. The skeptics dismiss it entirely, point to past false alarms, and go back to ignoring metals altogether. Both responses miss the point entirely. Understanding silver isn't about being bullish or bearish. It's about understanding what silver represents in the architecture of the global financial system. It's about recognizing that silver sits at a unique intersection of industrial demand, monetary history, and speculative psychology. Most investors treat silver like any other commodity. They look at supply and demand charts. They analyze mine production. They track industrial usage in the solar panels and electronics. All useful data, but insufficient. Because silver also functions as a pressure valve, a way for markets to express doubt about fiat currency stability without fully abandoning the system, a middle ground between holding cash and holding gold. And when that pressure valve starts to release, it tells you something about the pressure that's been building. The financial media will focus on the price. They'll interview traders who talk about technical levels and momentum. They'll show you charts with colorful lines, but they won't often tell you about what's happening in the repo markets, in the treasury auctions, in the currency swap lines, in the places where the actual plumbing of the financial system operates. And that's where the real story lives. Right now, we're witnessing the slowest debt crisis in modern history. Not slow because it isn't serious, slow because the mechanisms that governments and central banks have deployed to manage it are unprecedented in their scale and sophistication. When you owe more than you can ever realistically repay, you have limited options. You can default, you can grow your way out, or you can inflate your way out. Default is politically impossible for major economies. Growth is proving elusive in an environment of demographic decline and productivity stagnation, which leaves inflation. Not the kind of inflation that central banks target at 2%, the kind of inflation that slowly, persistently erodes the purchasing power of currency-denominated assets. the kind that makes hard assets look increasingly attractive relative to promises printed on paper or stored in digital ledgers. Silver's recent move isn't happening in a vacuum. It's happening as inflation expectations are quietly re-anchoring higher, as real interest rates remain suppressed despite nominal rate increases, as currency volatility increases across emerging and developed markets alike, as confidence in the sustainability of current debt levels comes under question, not loudly, but persistently. Let me walk you through what's actually happening in the broader economy, because context matters more than any single price move. Global debt has reached levels that would have been considered impossible just 2 decades ago. Governments, corporations, and households are more leveraged than at any point in recorded history. This isn't controversial, it's simple arithmetic. The only reason this debt remains serviceable is because interest rates have been kept artificially low for an extended period. Even as rates have risen recently, they remain below the levels that economic history would suggest are normal for this stage of the credit cycle. This creates a trap. If rates rise too much, debt becomes unserviceable, and defaults cascade through the system. If rates stay too low, inflation accelerates, and currency loses purchasing power. There is no clean exit from this position, only choices between difficult outcomes. Central banks understand this perfectly, which is why their actions over the past several years have been so carefully calibrated. Not to solve the problem, which likely cannot be solved without pain, but to manage it, to extend it, to buy time for adjustment. But time is not infinite, and the adjustments required are becoming more apparent. You can see this in the bond markets, where yields are telling a complex story about growth expectations, inflation risk, and credit quality. You can see it in currency markets, where emerging market currencies face pressure while even major currencies show unusual volatility. You can see it in commodity markets, where prices for essential inputs remain elevated despite demand softness. And you can see it in the growing disconnect between financial assets and real assets, between paper wealth and tangible wealth, between promises and things. This is the environment into which silver's recent volatility enters, not as a cause, but as a symptom, as a signal that some market participants are beginning to question the assumptions that have underpinned asset pricing for the past decade. History doesn't repeat, but it does echo. And there are echoes here that deserve attention. The 1970s saw silver experience extreme volatility as investors lost confidence in the stability of fiat currencies, following the end of the Bretton Woods system. That period taught us that monetary metals can move far more dramatically than conventional analysis predicts when the underlying monetary regime comes under stress. The late 2000s saw a silver surge as central banks deployed unprecedented monetary stimulus in response to the financial crisis. That period taught us that loose monetary policy and currency debasement create an environment where silver can outperform most other assets over sustained periods. We're not in either of those exact situations now, but we are in a situation that shares characteristics with both. A period where monetary stability is questioned but not yet fully doubted, where central banks are deploying extraordinary measures but maintaining a veneer of normalcy, where debt levels create vulnerability but haven't yet triggered crisis. In such environments, silver tends to behave erratically. It can remain dormant for long periods while fundamentals build. Then it can move violently as market psychology shifts. Then it can consolidate those moves or give them back, depending on how the broader narrative evolves. The key insight from history is this: silver tends to perform best not during stable periods of growth, and not during acute crisis when liquidity freezes, but during the transition periods, during the slow recognition that something fundamental has changed, during the gradual loss of confidence in the stability of paper assets. We may be entering such a transition period now, or we may not. The honest answer is that we cannot know with certainty, but we can recognize the conditions that tend to precede such transitions, and we can see that many of those conditions are present today. If you already hold silver, this recent volatility changes nothing about the fundamental reason you likely acquired it in the first place. You didn't buy silver to get rich next week. You bought it as insurance against monetary instability, as a hedge against currency debasement, as a store of value that exists outside the banking system and cannot be printed into existence by central banks. Those reasons remain valid, arguably more valid now than they were before this recent move. The worst thing you could do is let short-term price volatility in either direction cause you to abandon a position that was built on long-term reasoning. Markets will always be volatile. Prices will always fluctuate. But the underlying monetary dynamics that make hard assets attractive, as insurance, don't change with daily price swings. What you should be doing instead is reassessing your overall position size relative to your risk tolerance and financial goals. Not because silver moved, but because it's always wise to periodically review whether your portfolio allocation still makes sense given your circumstances. Some questions worth asking yourself: is your silver position sized appropriately for insurance purposes? Or has it grown too large relative to other assets? Do you have adequate liquidity in other parts of your portfolio to handle unexpected needs without being forced to sell during unfavorable conditions? Are you emotionally prepared for continued volatility, or would further swings cause you to make impulsive decisions? If you can answer these questions affirmatively, then this recent move is simply data, information about market conditions, not a signal to change course. Remember that holding silver is fundamentally a bet against the competence or willingness of monetary authorities to maintain the value of fiat currencies over time. That bet plays out over years and decades, not days and weeks. Short-term volatility is noise within that longer-term framework. The discipline required is to tune out that noise, to avoid checking prices obsessively, to resist the urge to trade around your position, to maintain the patient, long-term perspective that made the position sensible in the first place. This is harder than it sounds. Human psychology is wired for short-term thinking. We feel the pain of losses more acutely than the pleasure of gains. We seek confirmation that our decisions were correct. We want validation that comes quickly. But markets don't reward that psychology. Markets reward patience, discipline, and the ability to maintain conviction through uncertainty. If you don't currently hold silver, watching this volatility might create two conflicting emotions. Fear that you missed something important, relief that you avoided the stress of holding an asset that moves this dramatically. Both emotions are understandable. Neither should drive your decision-making. The question isn't whether silver moved or how much or how quickly. The question is whether the fundamental reasons to hold some precious metals as part of a diversified portfolio make sense for your specific situation. Those reasons haven't changed. They relate to the same macroeconomic forces we discussed earlier. Debt levels that likely require inflation to manage, currency volatility that may increase, geopolitical tensions that could disrupt traditional safe havens, monetary policy uncertainty that creates unpredictable outcomes. If those concerns resonate with you, if you believe there's meaningful probability that fiat currencies could lose purchasing power over the coming years, then some allocation to hard assets might make sense, regardless of what silver did in the past 3 weeks. But notice the language I'm using. Some allocation. Meaningful probability might make sense. This is not a call to action. This is a framework for thinking. The worst possible response would be to see volatility and feel compelled to jump in immediately out of fear of missing further moves. That's how you end up buying at poor prices, with poor sizing, and without proper context for what you're holding or why. If you're going to establish a position, do it for the right reasons, because you understand the role precious metals can play in a portfolio, because you've sized it appropriately relative to your total assets, because you're prepared emotionally for continued volatility, and because you're thinking in years, not months. Start by educating yourself properly. Understand what drives precious metals prices over time. Understand the difference between investing and speculating. Understand that no asset class goes up in a straight line and that patience is required to benefit from long-term trends. Then, if it makes sense for your situation, consider a modest initial position, something small enough that volatility won't cause you to panic, something you can hold through various market conditions, something you won't need to liquidate for other purposes. And recognize that timing is less important than consistency. The people who have benefited most from holding precious metals over time didn't get the timing perfect. They simply maintained positions through cycles, rebalancing periodically, and let the long-term fundamentals work in their favor. Let's talk about what happens in your mind when markets become volatile, because this matters more than most technical analysis. Human beings are pattern-seeking creatures. We want to believe we understand what's happening. We want to identify causes and predict effects. We want certainty in an uncertain world. Markets exploit this need mercilessly. They provide enough patterns to seem predictable and enough exceptions to ensure that prediction fails regularly. They reward confidence until suddenly they punish it. They create narratives that feel true until events prove them false. In environments like the current one, where multiple conflicting signals exist simultaneously, this psychological tension intensifies. Some indicators suggest economic strength, others suggest weakness. Some suggest inflation will persist. Others suggest deflation remains the risk. Some suggest markets are fairly valued. Others suggest extreme overvaluation. All of these perspectives have supporting evidence, which means all of them feel true to their adherents, and that creates a dangerous environment for decision-making. Because what typically happens is that people latch onto the narrative that confirms their existing biases. Bulls find bullish evidence, bears find bearish evidence, gold advocates find reasons to own gold, skeptics find reasons to avoid it. The discipline required is to hold multiple possibilities in mind simultaneously without needing to resolve them prematurely. To accept that we cannot know the future with certainty, but we can prepare for multiple potential outcomes. This is what thoughtful investors do differently. They don't predict, they prepare, they don't seek certainty, they manage probability, they don't react to every piece of news, they maintain frameworks that help them interpret information without being whipsawed by it. In the context of silver specifically, this means recognizing that the recent volatility could be the beginning of a major move, or it could be a false start that leads to consolidation. Both outcomes are possible. Both deserve consideration. What matters is not which outcome occurs, but whether your portfolio is structured to handle either, whether you have enough exposure that you benefit if precious metals perform well, and whether you have enough diversification that you're not devastated if they don't. This balance is harder to achieve than it sounds. It requires you to resist the extremes that feel emotionally satisfying but are strategically foolish. The extreme of going all in based on conviction, or the extreme of staying entirely out based on skepticism. The middle path, the path of thoughtful allocation and patient management, doesn't generate dramatic stories, but it's the path that tends to produce acceptable outcomes across a wider range of scenarios. This is perhaps the most important section of our discussion, because in volatile markets, avoiding mistakes matters more than making perfect decisions. Do not chase price movements out of fear of missing out. This is the most common error retail investors make, and it's also the most costly. Buying after sharp moves higher feels safe because momentum seems established, but it often means buying from more sophisticated investors who are distributing positions into enthusiasm. Do not panic. Sell into sharp moves lower. This is the equal and opposite error. Selling after declines feels like cutting losses, like protecting yourself, but it often means crystallizing losses exactly when patient holding would have been rewarded as markets recover. Do not overleverage your positions in any direction. Using debt or derivatives to magnify exposure to precious metals is a strategy that can work brilliantly in trending markets and can completely destroy your financial position when volatility increases. The reward is never worth the ruin risk. Do not follow social media hype uncritically. Online financial communities can provide valuable information, but they can also create echo chambers where confirmation bias runs wild. Everyone sharing rockets, emojis, and moon predictions doesn't make something true. It just makes it popular. Do not confuse volatility with opportunity. Yes, volatile markets create opportunities for disciplined traders, but they also create far more opportunities to make mistakes, to miss time entries and exits, to allow emotions to drive decisions. For most people, the best response to volatility is not to trade more, but to maintain discipline. Do not ignore your personal financial situation in favor of market narratives. It doesn't matter what silver does if you needed that money for something else and had to sell at the wrong time. It doesn't matter what the best investment thesis is if it's wrong for your specific circumstances. Do not stop learning. The macroeconomic environment is complex and evolving. What was true 5 years ago may not be true today. What's true today may not be true 5 years from now. Maintaining positions without maintaining education is a recipe for being blindsided by change. And perhaps most importantly, do not expect certainty where none exists. No analyst knows the future. No model predicts perfectly. No thesis is guaranteed to play out as expected. The moment you convince yourself that something is certain is the moment you become vulnerable to being catastrophically wrong. It's crucial to understand that what's happening with silver is not happening in isolation. It's part of a broader repricing of risk that's occurring across multiple asset classes simultaneously. Look at government bonds, where yields remain elevated despite central bank intervention. Look at credit spreads, where the compensation demanded for lending to corporations is widening. Look at equity valuations, where concentration in a handful of stocks masks weakness in the broader market. These are all symptoms of the same underlying condition, a financial system that has been stretched by decades of credit expansion, monetary stimulus, and the deferral of necessary adjustments. A system where asset prices have become disconnected from the underlying economic reality they're supposed to reflect. This doesn't mean collapse is imminent. It means tension is building. It means the system is fragile in ways that aren't immediately apparent. It means that when adjustments come, they may come faster and more severely than conventional models predict. Precious metals exist as a hedge against this fragility, not because they produce income, not because they grow, but because they represent a form of value that exists outside the system that cannot be devalued by central bank policy. That doesn't depend on someone else's promise. In a world where nearly every financial asset is ultimately a claim on someone else, this distinction matters. It matters more in unstable periods than in stable ones. And by many measures, we're transitioning from a period of artificial stability, maintained by policy intervention, to something more uncertain. We need to address the elephant in the room, which is the role of the US dollar in all of this. The dollar remains the world's reserve currency, the medium through which most international trade is settled, the asset that central banks hold as reserves. This creates enormous demand for dollars regardless of US fiscal or monetary policy. But that privilege isn't permanent. It's conditional on maintaining confidence. And there are cracks appearing in that confidence, not dramatically, but persistently. You can see it in the way countries are beginning to settle trade in alternative currencies. in the way central banks are diversifying reserves more actively than in previous decades, in the way dollar dominance is being questioned more openly in international forums. This doesn't mean dollar collapse. That scenario remains unlikely in any near-term time frame. But it does mean gradual erosion, slow decline in purchasing power, steady loss of the premium that reserve currency status provides. For precious metals, this environment is historically favorable, not because metals replace currencies, but because they become more attractive as a wealth preservation tool when confidence in any single currency decreases. Silver specifically benefits from this dynamic, while also maintaining significant industrial demand that gold largely lacks. It sits in a unique position, monetary asset and industrial commodity simultaneously. This dual nature can create explosive moves when both aspects align favorably. One of the great debates among macroeconomic analysts right now is whether the primary risk ahead is inflation or deflation. Both camps have sophisticated arguments. Both camps have historical precedent. The inflation camp points to debt levels that likely require currency debasement to manage, to supply chain vulnerabilities that have reduced productive capacity, to demographic trends that decrease the worker-to-retiree ratio, to political pressures that favor spending over austerity. The deflation camp points to debt dynamics that tend to be deflationary as they constrain spending, to technological advancement that continues to reduce costs, to aging populations that reduce consumption, to overcapacity in many industries that puts downward pressure on prices. Here's the reality. Both could be right in sequence. We could experience deflationary pressures in certain assets and sectors while experiencing inflation in others. We could see deflation in the near term as debt contracts, followed by inflation as policy responses overwhelm those deflationary forces. For precious metals holders, this uncertainty is actually not as problematic as it might seem, because metals tend to perform well in either extreme. They perform in inflation as a hedge against currency debasement. They perform in deflation as a safe haven when financial assets decline. What they struggle with is the middle ground, stable economic growth with moderate inflation and confidence in the financial system. That environment reduces the insurance value of metals and makes other assets more attractive. Right now, we're not in that stable middle ground. We're in a period of transition where the range of potential outcomes is wider than normal. And in such periods, having some allocation to assets that perform across multiple scenarios makes sense. Let's not forget that unlike gold, silver has significant industrial applications that create baseline demand regardless of investment flows. Solar panel production continues to grow globally as energy transition efforts accelerate. Each panel requires silver for electrical conductivity. As solar deployment scales, so does silver consumption in this sector. Electronics manufacturing relies on silver for everything from smartphones to electric vehicles. Medical applications use silver for its antimicrobial properties. These are not discretionary uses that disappear during economic downturns. They're structural demands built into modern technology. This creates a fundamental floor under silver prices that gold doesn't have. It also creates supply constraints, because silver mining is often a byproduct of other metal mining, rather than a primary focus. When investment demand surges on top of industrial demand, supply struggles to respond quickly. The recent volatility may partly reflect recognition of this supply-demand dynamic improving, or it may reflect something else entirely. But the industrial demand story provides a foundation that makes silver interesting beyond pure monetary considerations. We need to talk about the challenge of finding reliable information in the current environment. The internet has democratized access to financial information, which is largely positive, but it has also created an environment where noise often drowns out signal, where algorithmic content promotion rewards sensationalism over substance, where anyone with a camera can present themselves as an expert regardless of actual expertise. This creates challenges for investors trying to educate themselves. How do you distinguish between thoughtful analysis and clickbait, between experienced perspective and confident ignorance, between information and marketing? Some guidelines. Be wary of anyone who claims certainty about complex, uncertain situations. Be skeptical of price predictions, especially specific targets. Pay attention to people who explain their reasoning process, not just their conclusions. Value those who acknowledge what they don't know alongside what they think they know. Seek out sources that have demonstrated consistency over time, not just recent accuracy. Recent accuracy can be luck. Consistent quality over years suggests genuine understanding. And perhaps most importantly, take responsibility for your own education. Don't outsource your thinking to experts, no matter how credible they seem. Use expert analysis as input into your own decision-making process, not as a replacement for it. So where does this leave us? What should thoughtful investors do with the information we've discussed? First, recognize that we're in a period of transition. The policies that worked for the past decade may not work for the next one. The assumptions that guided portfolio construction may need revisiting. The relationships between assets that seemed stable may be shifting. This doesn't require dramatic action. But it does require attention. It requires staying informed about macroeconomic developments. It requires periodically reassessing whether your portfolio allocation still makes sense given changing conditions. For those with precious metals exposure, the recent volatility is a reminder that patience and perspective matter more than perfect timing. Your positions likely reflect long-term concerns about monetary stability and currency purchasing power. Those concerns haven't been resolved. They've arguably intensified. Stay focused on the multi-year framework that made the positions sensible in the first place. For those without precious metals exposure, consider whether having some allocation makes sense for your specific situation. Not because of what silver did in the past 3 weeks, but because of what the macroeconomic environment might look like over the next several years. If you decide to establish positions, do so gradually, thoughtfully, and with proper sizing relative to your overall portfolio. For everyone, the key is maintaining balance. Don't become so focused on one asset class or one thesis that you lose perspective on the bigger picture. Don't let recent market moves in any direction cause you to abandon long-term thinking in favor of short-term reactions. The 21-day period we've been discussing will eventually become just another data point in the longer history of silver prices. It may mark the beginning of something significant, or it may prove to be a false start that leads back to consolidation. We cannot know which with certainty. And that's okay, because successful investing has never been about predicting the future with certainty. It's been about preparing for multiple possibilities while maintaining the discipline to stay invested through uncertainty. What we can know is that the macroeconomic environment remains unstable, that debt levels are historically high, that monetary policy faces difficult trade-offs with no clean solutions, that geopolitical tensions are elevated, that the assumptions that underpinned the past decade may not hold for the next one. In such an environment, having some exposure to hard assets that exist outside the financial system, that cannot be printed or digitized into existence, that have held value across centuries of economic change, that's not radical, that's prudent. But prudence also means not overdoing it, not letting one asset class dominate your thinking or your portfolio, not making dramatic changes based on short-term market moves, not confusing preparation with prediction. The investors who will navigate the coming years most successfully won't be those who made the boldest bets or the most accurate predictions. They'll be those who maintained discipline, who stayed educated, who adapted their thinking as conditions changed without being whipsawed by every new piece of information. They'll be those who understood that markets reward patience more than brilliance, that survival matters more than optimization, that compounding modest returns over time beats chasing spectacular returns that never materialize. You're watching this video because you understand that something important is happening in financial markets. You're right. The transition we're witnessing is real, even if its pace and ultimate destination remain uncertain. Stay informed, stay disciplined, stay focused on what you can control, your education, your allocation decisions, your emotional responses, rather than what you cannot control, which is the market itself. The 21-day warning wasn't a prediction. It was an observation, a signal that volatility is returning to markets that had become complacent, a reminder that the calm of recent years may have been artificial, maintained by policies that cannot continue indefinitely. How you respond to that signal will determine whether this period becomes an opportunity or a setback in your financial journey. Choose education over emotion. Choose patience over panic. Choose long-term thinking over short-term reactions. And remember, the goal isn't to get rich quickly. It's to preserve and grow wealth steadily across changing conditions, to be positioned appropriately for whatever comes next, to maintain the mental and financial flexibility to adapt as circumstances evolve. That's the path forward. Not exciting, not dramatic, but historically, it's the path that works. Thank you for watching, and stay thoughtful out there.